What's up, YouTube? It's Todd Horse here with Tasty Tracker, and today I wanted to go over wheeling in practice for a new small account challenge. Not really a small account, but I'm wheeling Apple, and so I wanted to go over the way I do it, sort of my practice, and then you can sort of take what I'm saying along with other people and make your own adjustments and go from there. So let's jump right in. So to get started, basically, I believe wheeling should always start with opening a put, selling a put to get started, selling to open. Some people choose to do the stock right away. I don't like that because you're putting the entire amount of collateral at risk by owning all of those shares. It's not very efficient. And then if that stock were to plummet, it's very hard to continue to sell calls that can chip away at your cost basis. Obviously, the way I do it here, that can still happen, but the idea is that you've collected enough put premium on the front end to help mitigate that on the back end, where you can still exit out for much lower than what your strike you're selling is because you've collected premium over months and weeks, etc. So it starts off for me by selling the put. This is really the purest form, I think, of playing options. You can buy calls and puts, but I think, like, in an ideal world, selling puts is about as sweet as it gets, because most of my viewers here are Theta Gang fans, and so here we're collecting on the theta, the time value decaying, so price can completely stay static, and we're just getting paid interest basically daily. So that's one reason I love it. There's no offset of the Greeks, so normally you have, when you're doing verticals, which is what I do a lot of, the long leg severely offsets the short leg, and so with this naked put here, we're going to be getting a lot of theta premium. It's very real. You'll see the degradation in the contract, whereas on a vertical, you'll see it, but it's much, much, much slower. So it feels cool, but not as cool as this does. The one positive or negative, it could just depends on the situation, is it's way more volatile. So you'll see large swings throughout the day, throughout the week, throughout the holding period of that contract, where it will whip up and down at the whim of the market. So a small move in the stock price you'll see a large swing. So if you're over 25,000 and you can day trade, you can trade to your heart's content. Basically, if you're okay owning that share anyway, those shares, then you can completely open and close all the time, and you might win some, you might lose some, but of course I wouldn't exit out at a loss. I would just hold it until I was green and run the wheel like I'm running here. But on a good day, you might be able to exit out at a high, enter back in at a low, and just make that much more money on top of what you are already making. Okay, so I wanted to show the Apple put that I put on yesterday. It's already up 45% at $116. So, obviously, if I had bought the long leg here, say the 119, this would not be nearly as green as it is today. So the premium you're collecting, because you get to keep the entire premium you collected, that makes your break-even price better too. You can see, even though I have the 124 strike, it's way down here at 122 or something like that. Obviously, I could look if I felt like it, but So the break-even is even better than it normally is on a vertical. Okay. So I wanted to quickly point out here that you will get assigned doing this, and margin called. You need to enter this style of trade knowing that for a fact that this will happen, and being prepared mentally when it does happen. When you get the email, you can't be shocked. You need to have enough money to deposit into your account when you do get assigned so that you can take ownership of the shares. That's part of this, the wheel. If you don't take ownership, then you would have to close out for a large loss. So I would rather take ownership of the shares and then start selling covered calls on top of that. So, how do you know how much margin called you're going to get? You can do some quick math. Obviously, if you sold the 10 strike, you multiply that by 100. That's how much you potentially will need to come up with. However, margin expansion is actually quite a decent amount less than that. So I have a little tool, but I do need to mention here that PLTR, other tickers like that, will require more from time to time. The brokers, specifically Tastyworks in this instance, is requiring 50% for that one. They don't have a public list. I contacted their support. They're working on adding it to the UI so that you can see without contacting them. But in the meantime, if you go to open up a position and it has a larger number than what you're expecting, you can contact them and see what the exact number is, or you can play with my tool by going over to the tool. Here we have a hypothetical. This is, if you come to this page under lab and margin expansion, it will fill this out by default, and then you can just adjust it to your situation. But we're selling a put here for the 45 strike. We collected 50 cents in premium. We sold one contract, and the margin requirements are typically going to be 20%. But yesterday I had somebody use it and say their number that they were seeing in Tastyworks was quite a bit different than what I was generating. Even though I'm using Tastyworks formula, that issue was because this is 50% and not 20%. So you can just play with this number and in order to get it to match or thereabouts of what Tastyworks is showing you, and then you'll know from that time period on. But it can change randomly. So at one point, prior to the whole GameStop thing, margin on that was the regular 20%. But as soon as GameStop and AMC happened, those specific tickers went up to 50% or more of margin requirements. That's dictated not by the broker, but by the clearinghouse, which tells the broker, hey, we need to have X amount in order to feel safe about the position we have. Anyway, so hit go here, and now I can see this ticker. If it stays at the $45 price, I'll need $950, which is quite a bit less than the $4,500 that we would expect to need if I were in an IRA or if I wanted to have all the cash sitting on the side. My point here is if you have multiple short puts in your account and the stock market goes south, everything is going to come down at the same time. And so all of your positions are going to come up here and require quite a bit more margin requirements. And that's where people really, really get messed up. They end up having way more positions than what they can. They have to close out half or more of them at a loss in order to raise enough capital to sustain the other half. So you definitely want to use this tool, or just ideally you would have enough capital reserved to purchase the stock outright, because as I said, that's going to happen at some point. So the sooner you acknowledge that and have enough set aside. Now, the problem with IRA, with margin accounts, I contacted Tastyworks. They do not have a setting that will require the full collateral. So you just have to keep track of this on your own, or have it in a separate account. Like I have mine in my bank account. So I know for this position, I'm going to need roughly this much. I have that in my checking account, ready to go. So when I get assigned, I can just, and then get margin called, I can just move that money over, and I know it's not going to interfere with anything else if I keep that money over there and don't touch it. So that's how I handle that situation. Okay, so you would want to run this through to make sure you could cover as many positions as you have open short puts. Okay, so how do you select the tickers? Well, basically, I'm only interested in winner. So I'm thinking about companies that have been killing it for the past 10 years and are going to kill it for the next 10 years. And so that's why I chose Apple on this challenge. They're not going anywhere anytime soon. So even if they decreased in value, they would hit a floor where people would still buy their shares, for the foreseeable future. So select a good company that is going to be at a higher price in 10 years than what it is now. As far as price is concerned, I think under $50 is the most practical. If it's that little of a price, then you can potentially have multiple wheels going at a time to help reduce your cost basis. So you start off with one wheel that gets assigned, then you start another wheel by selling the put. And so then you're kind of attacking that long stock from both sides. You have your put that you sold chipping away at your break even, and your covered call that you sold chipping away at your break even. And if you do get assigned on the put on your second wheel, now since it's a lower strike, you've reduced the cost basis of all the shares. So and then you would start doing 2 covered calls at that point. But you really want to do more than under $15. So that would be 1,500 would be the total amount that you would need to take assignment of those shares, and actually less than that because you collected premium. But you really need more than $15 for the share price, because under that it's not liquid enough for the options. They don't have enough expirations. They don't have enough premium associated with it. So even around the 15, it gets kind of tight to say whether it's even worth it. Just a quick note while I say that, the ROI is not anywhere close to what you're getting on verticals when you're doing these. But especially if you're like me and calculate that based on the entire amount needed to take ownership. Yes, technically it's a bit better if you're in a margin account. But the flip side is you have a higher win rate, and your actual dollars that you collect can tend to be more because of the higher win rate and the increase in collection from theta and things like that. So it sounds counterintuitive that your ROI is worse, but your net income is more off of these, but that's often the case. Ticker selection, again, for me, weekly expirations is a must. If it just has monthlies, it doesn't give you enough options for rolling that you can't take advantage of situations when they arise. And I'll get into that in a second. Obviously, high liquidity. So, if you wanted to run the wheel on SPY, the premium's not as good because of how tight the bid and ask is, but you're never, ever, ever going to have an issue getting in and out of a position if you needed to. And of course, also with something like SPY, even if it does go down, and during the 2008 kind of market crash, it took a while for it to come back up. But obviously with an ETF like that, it's going to come back up at some point in the future. So I'm doing it on Apple here. Apple could dissolve as a company, but ETFs are even safer. So those are some things to consider. There are ETFs in this price range. Okay. Preferably it's been down on its luck recently and looking to turn up. That's kind of where Apple is at this situation from my perspective. It's pretty much oversold, kind of at the bottom of a range recently, been trading in this range for a year, so from my perspective there, it's only a matter of time before Apple starts moving again. And even if it doesn't, if it stays within its range, I could still choose to cash out when it gets kind of near the top of the range, wait for weeks or whatever until it got back down to the bottom of the range before I did it again. Or I could just keep on my merry way, whatever. So how do I choose which stocks? I wanted to show the watch list here. So this is public. Let me get rid of the DevTools. This is the public website now, so I did change this a bit. If you go to your portfolio, go to watch list here, then you should see Todd's watch list in your list of watch lists. You can create your own, or you can just use mine, but everybody should be able to see this. This is public. Okay, so here I have a list of a good number of the popular tickers that most people are trading day to day. If you see any here, if you see something that's not on here, let me know and I will happily add that if it makes sense. But so what I would do here is basically come in here, sort by last price. I did also add IV rank here so you can sort by that, but for this exercise, we're really interested in, like I said, something below 50. So here we have, just a little bit over what's displayed on my screen by default. So, Comcast, Pinterest, Intel, Coke, ETFs, Cisco, Twitter, ETFs, Bank of America, Fastly, Gold, CRISPR, ETFs, plugs, SunPower, Fubo, and PLTR, Rocket. And Rocket really is a great one for me. I'm extremely bullish on Rocket long term. I think online retail sale, online sale of property, your house is going to be huge in the future. So it's nicely at the bottom of this list. So that would be one if you wanted to follow along, but couldn't afford Apple. This one obviously requires around 1,700 in order to start wheeling on that. Okay. So that's how I would choose the ticker. Obviously, if you have a ticker that you like, that you're more than welcome to do that. But yeah, I would just caution you to make sure it's something of value. I don't know where Ford and GER or GM, those aren't ones that I typically play, but I do know Ford is a popular one. So that could be also something to consider, but not something I'm interested in. So I just wanted to quickly point out here, you will get assigned and margin called. So fully expect it to happen that you get, the market has a down day and you'll get margin called, even though your position is not even necessarily close to expiration, or your strike is even close to the price per se, you could still get margin called. So let's go back to this. I needed, was it 2,400 initially or something like that, to start the Apple position. And originally my buying power was around 500. And so at this point, I'm already up to, around 900 that I have buying power, available. My point here is I only needed 22 or 2,400. I put 3,000 in. And so, give yourself some cushion right out of the gate so you don't get margin called the day you open it up. Obviously, you don't want to constantly be getting those, but it will happen. Okay, so strike selection. How do I choose what strike I want to sell the put for? If it's in a margin account, you would definitely prefer to not get assigned. So with that in mind, I'm going to choose something a bit safer and under support, preferably under really strong support like the 50-day or the 100-day, definitely under the 200-day. And if that can align with other levels of support, that would be great. The more things you have stacked in your favor, the better. So, just a quick note, remember, you're not wasting money on the long legs. So the premium you see associated with that strike is everything you get to keep. So, normally you might go 40% in the money for a vertical, but with this, you might be able to go 35 or 30% or 25 and still collect similar premium, but now your odds of winning are that much better. The flip side of that, obviously, is the further away from the money you are, then the less the Greeks will be affecting that position, the less juiced the premiums are for that. But it's also, again, in a margin account where you prefer to not ever take ownership of the shares. So you have to strike that balance between the premium you're happy with collecting, making it worth your time. Another caveat there is if it's lower down in the chain, that's less collateral that you're going to need should you actually get assigned, because you're agreeing to buy it at that lower price. Plus, if it went the whole way down, say, I'm a 20% discount on apples where I sold the leg. Getting 20% off apples at today's prices, that's a pretty cool deal. So, these are all things to think about. If you're in an IRA, or you're very bullish, I'm more inclined to go at the money or even in the money already. So something like 55 or 60% in the money is more possible because in an IRA you already have that whole amount set aside in case you get assigned. You will never get a margin called, so all of that is reserved in case you get assigned on that option position. So you can you can be more aggressive and get more juiced premiums. The Greeks are really affected because it's right at the sweet spot. If the stock does moon and go through your strikes, it went from below your strike to above your strike, you're going to really kill it on that position and earn a lot. But obviously, if it tanks, the higher up you are, the longer it will take to roll that down. I'll get into that in a second. But it'll take you longer to roll that strike down and down and down to a point which is more appropriate for the price the stock is trading at that time. And then the other thing, the sub-bullet point I have here is it's going to require more collateral. Obviously, if you're choosing something at the money or higher, you're choosing a higher strike. You're agreeing to pay more for Apple than what it's currently trading at. So say Apple's trading at 100, I'm saying I'll agree to buy it at 110, but you just have to pay me more. Obviously, if I'm really bullish and it goes up to 115 and I was right, then that's a really good win. But I'm agreeing to pay it at 110. So now I times 110 by 100 instead of the 100, which is the at the money strike in this hypothetical situation. There was one thing that just came into my mind, which I forgot now. But anyway, I wanted to quickly point out here that you will get assigned and margin called. It's going to happen. So you need to prepare yourself mentally for that. Of course, not if you're in an IRA. If I remember what I was thinking, I'll put it in the notes here for this one. Okay. For the date selection, I'm looking typically say today's Monday, I'm looking for not this coming Friday, but the following Friday. So something around 14 days to expiration is ideal. And then once it gets to 9 days to expiration, I'm always going to be rolling out in that range. So 8 or 9 days. I don't want to hold it to the week of expiration because your odds skyrocket that you're going to get assigned no matter what strike you chose and no matter what strike or what price the stock is trading at currently. If it's expiration week, your odds of getting assigned are vastly higher than other times. So if you continually roll it out to have more extrinsic value, people are less likely to try to exercise that so that you won't get assigned if you keep it far out. So even if you have sold the 110, like I said in the example before, and it's trading at 100, I'm not going to get automatically assigned the second I open that because there's all that extrinsic value. And similarly, if I keep it rolled out, there's too much extrinsic value there that somebody would be wasting if they exercised their thing. That was what I wanted to remember a second ago, was that you will not get immediately assigned the second you open something and it's under your position, if that made sense. So I open up a 110 on Apple today. It's trading at 100. It's not like they assign me. There is diminishing returns though. So, if I were to say, okay, well, I'll just open up a 150 because I don't really care. I believe Apple will get there in the next year. You could do that, but at a certain point, the incremental premium you collect from one strike to the next is going to be the same as the width. So you're going $1 more and you might collect $1 more, but it's right around at the money where you can see discrepancies in the price where you can collect more because those are on the bubble and they're also more actively traded. Okay. Wanted to quickly point out here that you will get assigned and margin called. So if you can just have that in your head and not get freaked out when it happens, that would be great. Okay, let's move on to management. So, under verticals, I say always roll for a credit. Only in rare instances should you roll for a debit when it's a vertical. But realistically, that turns out to be maybe 25% of the time. It just depends on the market. This year, 2021, has not been kind to verticals, so rolling for a credit is almost always impossible. And we've been rolling for debits, in theory, very small debits, but then obviously doing that after a time or two, you're chipping away at the amount that you had collected. So say we collected our 160 that I like to for verticals, then I pay $20 to roll, and then I pay $20 again to roll two debits. Now I'm down to 120, and at that point, the position no longer even makes sense. Even if I won, I'm only getting 120 and probably would want to close at 50%, and those strikes are super far away. That's why I had to pay a debit to roll. If you've done this, you know what I'm talking about. It becomes a whole mess. So rolling for a credit is an ideal situation. Then it doesn't always happen, and it especially has not been happening in 2021 because of the choppiness of the market. With this naked options, the extrinsic value will always be more next week than it is this week, right? So if I'm rolling it out, I should always, assuming I keep the strikes the same, I should always be able to collect more credit because I'm giving more time for the trade to go against me, if you want to look at it that way. Okay, so you'll always be able to collect a credit when you roll it out, all things being equal. What are those other things? Well, that could be like implied volatility and stuff like that, but we'll get to that in a second. But 99% of the time, you should be able to roll out for a credit. Might not be a huge credit, but you should be able to roll out for a credit. Okay. So how do we manage? This is basically the page you would want to sort of screenshot and print out if you're that type of person. But if the stock is flat, and it stays flat for an extended period of time, you would just keep rolling out. Once it gets to 9 days, you roll it out again. It gets to 9 days, you roll it out again. All the while keeping the strike the same. You're rolling out to the next expiration. You're collecting a small bit of premium the whole way along, just making that position more and more profitable for you. So that is sort of the best case scenario, the ideal. That's not the best case scenario. That's the ideal situation in my head. If the IV increases drastically, the premium that position is worth is now more because IV, implied volatility, affects the pricing of an option. The higher the IV, the higher the premium. What that means, though, is if you collected $100 in premium and then after that the IV skyrockets, now that option might be worth $150, even if the stock didn't change price at all. When that happens, ideally for us, we still want to take advantage of that IV spike because naturally IV will come back down to an equilibrium, and so we want to capitalize on that move. So the way we're going to do that is to roll out to the next expiration and keep the strike the same. And you will know that when that happens because, like I said, the stock price will stay around what it has been, but all of a sudden your position is red by $100 and nothing else has changed. So you see that and you see, oh, my position is red, it's down quite a lot. I'm going to roll it out and take advantage of that premium, get the extra theta, extrinsic value, but then also in that wrap in extra IV I can collect. If you don't choose to roll it out at that point, things will come back to an equilibrium on their own, and you will then, most likely your position will turn green, but you just missed out on collecting on that spike of IV. So, so I tend to manage the positions most when they're red, because that means there's opportunity for me to collect more. So that's your sign when your position goes red. Okay, if the stock plunges, and so I sold the 75 strike and it plunges down to 50. You want to roll out an expiration and then down a strike. And you may be able to do one strike at a time. You might be able to do several strikes at a time. But the idea here is that you keep rolling it out and down and out and down and out and down. And if you stay far enough ahead and it doesn't move so crazy that somebody does early assignment. Excuse me. If you don't get if you keep it far off out ahead, you're less likely to get assigned, and so eventually you can work your way down in theory. So if the stock moves, I would just roll up. I would keep the expiration. When I say roll out, I mean roll to the next expiration. When I say roll up or down, I'm talking about within the chain. So if the stock moves, just roll up in the chain. And you obviously should keep the supports in mind, but this keeps the Greeks in overdrive. You stay around at the money, or where you're comfortable with whatever buffer you're comfortable with, but you're keeping your position more relevant. We know the further out extremes here on the chain, the less affected by Greeks are. So if you're trying to stay near that middle of the chain, you're going to be able to collect a lot more. Obviously, that increases your risk of assignment because you're now closer to the strike, and also decreases your margin. So if I was at 100 and I rolled it up to 110, now that's $10 more that I'm responsible with per share. Okay. So I always have a working order. So if we go back over here to Apple, I have a rolling order to just roll it out 1 week for $80 credit, right? And at one point today, I could have sworn this was at 0. Maybe that was the AMD position. I'm not sure. But I just keep this ideal out there. If I get 80, that would be I would be more than fine to roll it out for 7 more days for $80. This may or may not hit, but you'll get these weird spikes, or during the morning action, somebody might come in here and take the trade for you, and that's great. If that doesn't happen, if that doesn't hit, then again, once this gets down to 8 or 9 days, right now it's got 14 days on it, then I will roll it out at that point manually and take what I can get. But either this hits or I see an IV spike or something like that, which usually those things happen where it might take a dip. So right now I'm up 119. It might dip down to 60 or something like that. And I think it's only a momentary thing, then I might choose to roll it out at that point. But I always keep a working order there to get the ideal. And then only interact if I have to. So what is the most ideal credit? That comes with experience. You can sort of base it on what you've collected originally. Normally, you won't be able to collect for each roll what you did originally because you have to close out the old strike. I hope that makes sense. So originally you might collect $300, and then to roll it each time you can only collect $50 or $100 or whatever. So if you've been successful at closing at $100 for the past 3 times, then you might want to put in an ideal roll of 125 or 150 just for shooting for the stars here. What's the worst that could happen? You roll for more than what you've been able to roll for previously. That comes with experience, but generally, I might take the roll and then mark it up by 25, 50%, whatever I want. So here I've doubled about what is the going rate for it, but right now it's trading for 45 and I have it in for 80. Okay, next thing I wanted to talk about was being choosy on when you roll it out. If the stock dips $1 and it looks like it's going to dip another $5 after that, don't roll out now, obviously, because you would wait until the entire move has happened. Essentially what you're doing is, if you roll out too soon, is chewing up expirations. So you can begin to paint yourself into a corner if you roll so far out now because you keep rolling it out, where you'll the Greeks are no longer effective. So theta, now you've rolled out past to the point where theta is actually eating away at your position. Obviously, it's always eating away, but it's obviously picks up closer to expiration, right? So if you've rolled it out, like 3 days in a row, you've rolled it out another week. What was supposed to expire next week and it was really pounding on the theta now is a month out, and it's that less less affected by any moves. So you don't want to paint yourself into a corner. You want to be choosy when you roll it out, when the opportunity is most beneficial. Sometimes it's out of necessity where, I have to roll out because I'm going on vacation for the weekend. Not for the weekend, for next week, and I don't want to manage any of my positions, so I'll go ahead and roll it out 2 weeks at that point. Typically, I am only rolling a week at a time, but there again, if I'm liking the premium, maybe there's triple witching or something like that where IBs increase just for a specific expiration. You can see that in Tastyworks. Certain expirations have more volatility. So if I go to trade here, okay, so you can see here, this obviously has a lot of IV. This has lower IV. 1 second. So that might play a role into what strike you or what expiration you choose, but otherwise I'm typically rolling out a week at a time. Okay, so I just wanted to quickly point out, you will get assigned, you will get margin called. If you're entering this style, a naked put, and expecting to go a long period of time without this happening, you're delusional. This will happen, and it will happen quicker than you probably think or want. Okay, assignment. When it does happen, I basically am looking to sell covered calls as close to break even as I can. Obviously, I want it to be above break even unless it's like way far down, completely the floor fell out, which again should not happen if we're choosing good quality companies. However, the cheaper companies, like I was saying, Rocket, something in the $15 range, the odds of that happening are increased because they're not as established companies. That's why they're trading at that price. But anyway, you obviously want to sell the covered call above your break even, so that way if you do get exercised, those shares get called away, you didn't lose on that position. Again, the only caveat being if it is way far down there, then I might risk it, but that's a risk that you have to know going into it that you could end up losing a little bit of money there. If you choose cover call way out there, you're not going to collect that much premium. So that's why I'm saying just pull it in as close as you can to get the most. And I really want to press the issue. I want to force the market to go through my strike and then to get those shares called away from me. That's my ideal. Again, the call side is not where I'm interested in making money because it requires more money down, especially in a margin account. I want to not own the shares, not have all of that risk associated with it, only happen if and when it happens. But for the most part, I want to be doing all my action on the put side. That's my preference. So how do you calculate the break even if you've been doing it a while? So say you're lucky, you're choosing safe strikes, you're in a margin account, you are doing Apple, but you've chosen safe enough strikes that you've gone on for a year now without actually getting assigned. First of all, congratulations. That's, you chose well, or luck was on your side, or, maybe it was during the Corona recovery where the market went straight up. How would you calculate the break even? You could take all of the premium you've collected over that entire year and subtract that from the strike price. And that would give you the break even, what your actual break even is, but then you're kind of undoing all the work you did for that entire year. Whether you want to do that is up to you. It might make sense if something dramatically changes about that company. So I'm in Apple, something fundamentally changes where they say they're moving to just an OS and not selling their hardware anymore or something like that. That would change my perspective. And maybe at that point, I'm just looking to get out of the stock, out of this wheel permanently, and I don't really care. Obviously, I don't want to lose on the position, so I'm going to try to put it above my break even. But that might be an instance where I'm taking all the premium I've collected from that year and use that in the equation. Maybe an alternative would be to use the last two rolls and consider all the profit prior to that to be not part of this position, and or you can come up with your own thing. But here's an example of how this last two rolls thing would work. So for AMD, I've rolled it several times now. Say for the last two times, I got an 85 credit for the one roll and 35 credit for the other roll. So I have a total $1.20 credit for rolling my puts. Strike was 76, and then I get assigned, so I'm buying the shares at $76. I can take 76 minus the $1.20 and come up with about 75, 74 and a half. Again, whether I feel comfortable, say I've rolled it 10 times before this, going down to 74 and a half would be obviously okay. I'm eating into maybe 2.5 rolls instead of 2 rolls. But the point is that I'm still reserving all the other capital that I've collected throughout that time period as profit and no longer considering it part of this position. If it plummets to 50 and it doesn't look like we'll hit 75 in a long time, you can try going below your break even, like I was saying. So our break even is 75, but maybe I'm okay doing it at 70, just collect more premium and risk losing $500 if it were to shoot up through. Of course, at that point, you might be able to roll the covered call out, but I guess that might be a whole different topic. But yeah, you could roll the covered call out that you had at 70. If it went to 75, you could roll your covered call out to up and out. So the inverse of everything I'm talking about here. You could roll it up and out and collect more premium and get to a point where you're now break even again. So that would be a potential to how you would manage it then. Yeah, because what can happen is if your price at 75 and now the stock's trading at 50, you're going to get, pennies compared to what we were getting dollars here. We'll get pennies here. So if it's too far away from at the money, it can take forever to chip away at the price. If you've done covered calls before, you know what I'm talking about. Okay, so I just wanted to point out here, you will get assigned and margin called. Profit taking. So, I view this as something that I'm more than happy to take the shares of. So it's not really a short-term position like verticals are for me. This is more like long stock is how I mentally categorize it in my head. When I'm doing verticals, I'm taking things off at 50% profit because I want to get in and out of that ticker. I like the ticker, but not so much that I want to hold it indefinitely, right? With these, I'm okay holding indefinitely, barring something crazy happening. So while you most definitely can close at 50%, let's check to see what we're at over here now. 48. This would be, I could probably have closed this out for 50% today. Maybe that makes sense if you want to try to scalp a couple dollars, or maybe that makes sense because you like the ticker, but you're not in love with the ticker. Whatever. That's a very common thing for people to take it off at 50%, just like they do verticals. And then they can choose another ticker or strike expiration and move those things around. For me, I'm just going to keep locking in that profit, keep sticking with the company that I enjoy, again, unless something crazy goes wrong. So I tend to just keep pressing my luck, being very aggressive, because I'm okay taking ownership of the shares. So with that comfort, I can say I'm going to collect as much premium at whatever strike I can. If there's a little bit of bias towards one strike, I'll hit that one, and that's fine with me. So if when I'm saying bias, if a strike is juiced up more than the others, that doesn't usually happen, but it can. Okay, so there aren't that many tickers that I love. Even the watch list. These are ones that I would do verticals on, that I'm interested in trading on, but not all of these I'm interested in doing long-term holds. That's the distinction there. Okay, my profit. So I'm rolling these indefinitely. I'm never looking to close out of the position. So how would you calculate the profit then? My profit is what I collect on each roll. So when I roll it, that's at the time where maybe in Tasty Tracker, I would, instead of doing the roll using the roll feature, I would just close that old position and open up a new position. That's not what I typically do. I just keep rolling it. But yeah, that's how I realize the profit is is during that time, I'll take that profit from the premium collected from a roll, and I might put that into another position, or I might use that to bolster my cushion, so that way there would come a point in time where I don't even have to pull it out of the bank account to cover assignment. I can just have it all right there. Of course, if I got to that point, I probably would pull that out and put it in the bank account. But yeah, that's, again, your choice, semantics. Okay. Yeah, you're going to get assigned. So here are some other things, other videos I've done in the past. Option approval level, you're going to need a higher option approval level to write naked puts. Running the wheel makes no sense is where I talk about selling covered calls first, and how the goal of running the wheel doesn't make sense. The distinction, even though this is called wheeling in practice, the distinction here is my focus is on selling puts, and I only do the wheel half of it as short as I can and only as a backup plan to make the best of a situation that went against me. Okay. Option Greeks, I talk about them being more potent at the money and the different Greeks that there are. Option assignment, I also have a couple real world examples of getting assigned, but this should help numb you and prepare you for what happens during assignment. Margin expansion, I go over this little tool and talk about how it increases covered calls and why I hate them. Again, part of the wheeling, it makes no sense. Covered calls is more like, I don't like how much capital you have to have. I don't like the pennies that you're getting for selling covered calls. So those are kind of summary of some additional videos you might find interesting, but I did cover everything in this video, I think, that is pertinent to knowing how I operate the wheel. So yeah, do all the typical YouTube things. I have charts on Twitter, Discord chat, getting more and more into Discord alerts for analyst upgrades, for earnings, upcoming earnings results. So these all things are things I'm working on or have already done. Tasty Tracker's my site. I do have pro tier and a supporter tier, which is really just there to help me out, or a tip jar as well I have. So if you're interested in following me along and supporting me, you can do those things. And obviously, these are all just my opinions. It's been a long episode, so thanks for sticking with me, and I will talk to you next time.